All right, let's just take a quick look at this FRG business. I've got some revenue and EBITDA trends by year up to the 6/30/2023 last set of financials that we've got. So stepping back for a second, crux of the matter, B. Riley, 31% ownership interest in private franchise group for $281 million. So that $281 million sits on their balance sheet inside of their equity securities portfolio. It's a level 3 investment, means no quoted price. They've got a range of assumptions they can use to value that, opt to use the fair value method. Some are out there saying, oh, they need to consolidate it because of the Brian Kahn loan. Others are saying, oh, it's worth zero and they need to write it down. So I just wanted to look through some of the segments and just talk about what FRG means for a second. So one, this is a private investment in a private company, right? So privately held, they're not going to disclose financial statements, P&L, balance sheet, yada yada. We're going to get the quarterly and arrears look that we get because it's a private company and they're not required to report public financial statements for it. So yeah, it's treated like a private company, just like a BDC would in how they report on their holdings. Two, it's basically an LBO, right? I mean, they lever up to buy the equity, and now that it's private, they'll have a little bit more leeway in executing the plan and their thesis to, ultimately reap the reward of what they think the bet is there. Third, mark to market. So I think that's really what I wanted to look at and say, they're going to have a range of discretion to apply valuation multiples to this. So I just wanted to see for myself, is it worth 281 million or at least close, and see what the deal is there. I guess fourth is the consolidation matter. I just they got 281 million invested in FRG, right? And they've got a $201 million loan, personal loan to Brian Kahn. Personal loan. So I see people out there saying, oh, they got a $482 million stake in FRG. They need to consolidate. Well, no, that's not how it works. This $201 million loan to Kahn is a personal loan to him, and it's backed by FRG shares as collateral. But that doesn't mean they own or control those FRG shares yet. If Kahn were to default on this loan, and then they were to go seize those FRG shares, then yeah, they would have a $480 million stake and probably would need to be required to consolidate in that scenario. So just because this exists doesn't mean they need to be consolidating this right out of the gate. And I'm not even going to comment on the whole fraud matter because I don't think that I can know whether Bryant was involved in any of those things at what point in time, and therefore there should be clawbacks. But as far as I see it, they put 281 million into FRG, and that is the maximum exposure they've got to FRG. So if FRG went to zero tomorrow, B. Riley would write down that $281 million stake, and that would be that, right? Now, sure, you could argue maybe it would impair this loan to Kahn, but technically it's a personal loan, and I think they've got personal guarantees on it. They would probably go pursue other stuff from him to recoup that. Whether there's anything there, I don't know. But the FRG shares are just collateral to that loan. They also have personal guarantees, so you better bet they'd be pursuing it for other stuff. Okay, so those are the things that I just wanted to rant about for a minute. Okay, so let's look at each of these businesses. Here's this investor presentation from December where Bryant made the case for, I don't know, just shy of $6 billion of total potential enterprise value for these businesses. I saw a lot of criticism on the, hey, we used 2022 EBITDA for 3 of them and 2026 EBITDA for 3 of the other businesses. What's up with that? Well, I thought he laid it out pretty nicely in the presentation, saying, where is it? So the plan. What's the thesis? We bought this, and 3 assets we intend to monetize right away to de-risk, right? It's an LBO. We'll sell 3 of the assets that are not part of the long-term plan and repay debt. So Vitamin Shop, Buddies, and Sylvan were in that. They've already mentioned they've got a buyer for Sylvan. and Vitamin Shop is on the block. So let's see here. Let's just start filling in some numbers. Let's fill in some numbers. Okay, let's see. They pegged Vitamin Shop at 135 million, 7 to 10x EBITDA. None of the stores are franchised for that, or almost none of them are franchised. So it's really not a franchisor business. I think Bryant made the argument that it's closer to 120 million trailing now. So even on a 7x EBITDA multiple, you're looking at 840 million. Sylvan, we know, was 185. Corporate expenses, I don't see any reason to think it's going to be better or worse than the 12 million that they've experienced the last 7 quarters. Or sorry, I guess that's 6 quarters. And then Badcock, we know that. They got 24.5 million shares of CONN, C-O-N-N, and that's trading at $3.50 a share, so it's 85 million there. All right. Okay, so we're just filling in pieces to get a total enterprise value. And we know from the presentation here that in August we had a deal closed with 902 million of total equity, right? There's RILY's stake in that. Total debt was 213 million, total cash was 57. So we got a net debt number right here. Start labeling some of these. Total EV, total equity. Okay, we're just trying to get to a B. Riley stake of, there we go. All right, so we're just trying to see if that 281 million is close to legit, right? Because everybody's saying it's worth 0. All right, Buddies. Buddies is a franchisor. It's actually a decent business, but again, it's caught up in that rent-to-own value consumer downdraft that American Freight is seeing, and Badcock is seeing, and Rent-A-Center and Aaron's and all those other companies. So I don't know that I would put a, what did he give it? He gave it a 9 to 11x multiple on 16 million of EBITDA. I'm going to use this 14.8 number and maybe 8.5. Okay. Pet Supplies Plus. We'll save American Freight for last. Pet Supplies Plus. This is a really great business. It's a franchisor, so you can't necessarily comp it to other pet supply companies that are out there. It has grown nicely. So what did they say? They said by 2026, it's worth 11 to 13x EBITDA, 185 million of EBITDA from 116 today. And I think he laid out the math. Yeah, so here it is. Okay, they make money 2 ways, right? So they get royalty fees from the franchisees. It's pretty common. And then they also distribute products to the franchisees. So kind of like a wholesale arrangement. They've got 260 stores in the backlog, and the typical store generates 250K to the franchisor. So 260 stores times 250K, 65 million annually, plus our 116, and voila, there, that's the math, right? So it just comes down to, can they deploy that backlog and get those stores opened over the next few years? Okay, so what did we say? We said 115 million of EBITDA, and 2023 is shaking out close to 125, 130. That was as of December, so let's just use equals 125 times, I don't know, a 10.5 multiple. And before you push back on that, where is it? I've followed this company for a while, since they came public. Driven Brands is a franchisor of some like auto repair type franchises, and this thing is still trading at 12x EBITDA. It's massively levered, right? 4 billion of debt on 550 million of EBITDA, and EBITDA is falling. So if this is worth 12x, then Pet Supplies Plus, which is growing, should absolutely be worth 10. Should absolutely be worth 10. So I don't know. That's my like off the cuff validation of that. Okay, so that leaves. So already before American Freight comes into the picture, we're at 181 million for B. Riley's stake. So if you were to say, yeah, that's worth zero, then sure. I mean, you could make an argument that they should write it down by 100 million, but I don't think that that's legit. Um, American Freight. So Bryant said, blah, blah, blah. It's a great economic story. Yeah, doing great in 19, 20, 21. And then in 2022 and 23, they got caught up with much of the COVID supply chain aftershock, whatever you want to call it. And tons of other retailers are out there, right? Go look at Newell and Stanley Black & Decker and other companies that are getting hit by this, where earnings just basically went to zero because of inventory, COGS, supply chain situations. So the whole bet is really, the whole FRG bet by RILY centers around this one investment, in my opinion. And he lays it out in this one sentence. So the business was going from 100 million in EBITDA to losing money, and that created a stock price that went from 50 to 21. And our bet is this business turns. And then they went on to say the guy running it has incentive comp that kicks in at 150 million of EBITDA. So, where is it? Here it is. This lays it out perfectly, I think. This is the EBITDA by brand this is an old franchise group investor presentation. So here are each of the brands, right? Here's American Freight, this light baby blue color, and you can see EBITDA in 19, 20, 21. 100 million, 115, 108. In 2022, it went to 3.7. And then we know in TTM 2023, it was negative. So 100 plus million pre-COVID EBITDA down to a negative number. So I don't think it's reasonable to say that that business is worth zero or negative, right? And there's got to be an alternative way to value it. So my best argument at this point is just to take a couple of these other rent-to-own comps. So Upbound is the old Rent-A-Center, Aaron's, and then a spinoff entity from Aaron's, Prague Holdings, Progressive Leasing. So these are, I don't know, call it half of sales to 0.8x sales at the high end. And I think that's probably the best way to value this company, as earnings went negative until that recovery takes shape. And it should take shape. So let's take the TTM revenue of 855. Let's see what it is at 0.5, right? So at half of sales, it's $427 million. And let's see, what is it? Oh yeah, franchise. Here we go. So in 2020, they bought it for 450 million, right? So I've got it at half of trailing sales, puts it at 427. I think that's probably a pretty reasonable marker. So all those pieces gets me to 312 million for the equity stake. And we could, you could massage some of these down, right? Well, I don't know. So even chipping away at a couple of those, I'm now at 267 million versus a 281 million dollar stake. So I think that number is probably pretty good. And frankly, if you can get behind the growth argument around American Freight and Pet Supplies Plus, then there's real upside, especially if Vitamin Shop, Buddies, and Sylvan get sold and use those proceeds to repay debt. This is, what is this? This is, oops, we got Vitamin Shop, Buddies, and Sylvan. That's potentially 1.15 billion of your sub $2 billion debt balance. If you're talking about having 800 million of debt left on, the 120 million in growing pet supplies business and the American Freight business that could get back to its pre-pandemic level of 90 to 100 million in EBITDA. That's a pretty interesting setup. So I don't know. I think that's what they're seeing in the case that they laid out in this presentation. They laid out 238 million of American Freight, and I think he gave some math to get there. Maybe he did. I don't know. That one seems a little bit more challenging to me, but I think that this is easily a 250 million EBITDA business between just American Freight, and Pet Supplies Plus at the end of the day. So, yeah, I don't know. That's my math on the $281 million franchise group investment. Would love to hear some other thoughts.